Welcome back to the program. It's Capital Market Live on Channels Television. Before the break, the manager and head of research at Agusto&Co, Jimmy Ogbobine, told us how the Nigerian capital market rose to record highs in 2017 and how the debt market is, of course, faring as it were right now. So let's get back to business, Jimmy, and let's look at how foreign investors' activities in the NSE specifically now shaped things in 2017.
Okay, so like we said, the Nigerian story, the 30% party we already talking about in the capitalization, we could have actually seen such in the last 3 years as well, year on year. Right. But we sort of messed things up with our hands because of the foreign exchange issues after the drop in oil prices, mismanagement of policies on foreign exchange. But eventually we got some sanity in policy, in the policy environment. We introduced a new market, rate stabilized at about 360. Yes, exactly, the investors and exporters window, rate stabilized at about 360. We're able to converge rates. We're still keeping this holy grail market at 305, the central bank official market, and I hope we can get to talk about that as well. So with that, everyone said, okay, now things are fairly stable. It's obvious this 305 market will be with us for a while, but let's keep things focused on the 360 market, which is the investors and exporters window. And then as investors started testing that market, we saw it was a working market. It wasn't a market being rigged. And then that spurred investors' confidence. And confidence is the lifeblood of every economy. Yeah. And as confidence spurred, what did we see? We saw a reflection on the markets, the stock exchange. And then more and more, we saw a rally on prices because over time, for instance, many banks had been trading at a discount to their book values. Yeah. So what that means is that there was potential for a rally in prices. At the same time, some of the industrials as well, they were dropping to record lows, which just made them attractive buys for investors. So now all that has happened. And like we said, going forward, the question is, can we maintain this momentum? And what are the factors that will help us maintain this momentum? It was a good year in the equities market and as well the treasury bills market, the fixed income markets, because with record inflation, high inflation, we had double digit, not just double digit, we had 16, 17, 18%. At the beginning of the year, we started with about 22% in 364 days treasury bills as a result of the high inflationary environment. And as the central bank began to rein in inflation, rates started to drop to about, close the year at about between 17 to 18%. But at the same time, we're going to face a lot of inflationary pressures this year, partly because of one major reason. Which is? The federal government's fiscal deficit. It's a ticking time bomb on the Nigerian economy. And what do I mean by the fiscal deficit? The revenues being lower than the expenditure. So you have, we're celebrating, we have a budget of about 8 trillion and all that. But the question is, how do we fund this budget? You hear the National Assembly cry all the time, cry like babies, as if it's not their work to make laws about the government not funding the budget. But the reason why that isn't happening is because of the big fiscal deficit, which is also spurring inflation, and which is why the government has to borrow all the time, to fund the budget. Okay, so, but then talking about this borrowing, that we recently had a report from Fitch Ratings, and we read out that earlier, talking about the fact that banks are likely to, be on the losing side, especially in terms of being able to make profit this year, because federal government is not going to be able to issue more this year. What do you make of that? Is that going to be? Is that what you see at Agusto as well? Not for the entire year. Yes, you may have quarter on quarter. You may have some nuances in quarter on quarter. Now, what the government is doing is trying to change its strategy on treasury management, which is borrow from outside in foreign exchange to fund local spendings. But like we're talking about the Kenyan experience, even borrowing from the outside because you think yields are lower, as politics takes over, and these elections will be tough. They will be very tough. And because the elections will be tough, the rhetorics arising would lead to more instabilities and it will rattle confidence. What's going to happen in that instance is that even our yields on foreign borrowings most likely would increase. Again? Yes.
So we're not likely to have it sustained at this
in the
level.
second half of the year, most likely it won't happen.
So if that happens, going by the norms of economics, that means we're going to have a decline eventually in the equities markets.
I don't want to hit that nail on the head, but we're in a China shop with a bull we need to keep tame. And there's more than one bull in that room. There are various bulls. And how can we tame all of them? One bull I've said is the exchange rates.
Yeah.
How would we allow the markets determine rates? Rates are stable at 360 right now. But what happens if the naira has to depreciate further? Would the central bank allow that be? Would the central bank allow the markets determine rates? If the central bank allows markets determine rate, then that's keeping one bull tame in the China shop. Another bull in the China shop is the fiscal deficit. And what we see that has been happening, because interest rate payments, about 50% of revenues. You're looking at even a best case scenario this year, 3 trillion in deficit. The economic recovery and growth plan says that we'll sell assets to fund the budget. But do we have the political will to carry out these kinds of reforms, to sell assets, to liberalize prices? Look at prices, talking of liberalization of prices. Look at the last fuel scarcity in the last week of December, which will affect the downstream companies on the exchange, in the markets. What's the policy direction for that? We do not know. And why is that very important? We talked earlier about the official market of 305. Why is the central bank still retaining that market, even though things have stabilized on the investors and exporters window? Because that's a fiscal sweetener for the downstream petroleum market. So we need to give them this 305 exchange rate so that we can all buy fuel at 145. Are we ready for this reform?
Okay, so given all of these projections that you have explained now, let's look at the global factors that could actually impact us. Anyone you see at Agusto?
Yes, the first major political factor, global factor, is hate Trump, love Trump, but his reforms thus far are investor friendly. Okay. And what's the first major reform that he has done that has been investor friendly? The tax cuts. Corporate tax rates in America right now are lower than corporate tax rates in Nigeria.
Right.
At 20%, that's way lower than Nigeria's 30% plus.
Okay then. Thank you very much, Jimmy Ogbobine, for making it down to Capital Market this evening. We really appreciate your time and your analysis, and we hope to have more of you. Next week, let's watch out, investors, for DMO's Q1 2018 bond calendar, and of course the Nigerian capital market looking to come up with its recap and 2018 outlook. Lastly, we should be seeing the first edition of the 2018 Nigerian Savings Bond announced possibly next week by the Debt Management Office. Well, that's the show for this evening. Thank you very much for being a part of it. I'm Temple Ashaju, and see more of you in 2018.